Hello everyone, welcome to our channel. Today, we're diving into an important concept in finance and investing, the economic value of equity. So, let's break it down together. Interest rate risk in the banking book, IRRBB, refers to the potential impact of changes in interest rates on a bank's earnings and economic value. Banks typically have a mix of fixed and variable rate assets and liabilities, making them vulnerable to interest rate fluctuations. Effective management of this risk is crucial for maintaining financial stability. One of the key metrics used to assess this risk is the economic value of equity, EV, which provides a comprehensive view of a bank's exposure to interest rate changes. Economic value of equity is a measure used to evaluate the impact of interest rate changes on a bank's equity. Unlike accounting measures, which look at historical costs, economic value of equity focuses on the present value of all future cash flows expected from the bank's assets and liabilities. By doing this, it provides a more comprehensive view of the bank's sensitivity to interest rate fluctuations. In simple terms, economic value of equity helps us understand how changes in interest rates affect the overall economic value of a bank's equity. The economic value of equity is calculated as the difference between the present value of a bank's assets and the present value of its liabilities. Present value of assets is calculated by taking the sum of the present values of all future cash flows from the bank's assets, discounted using an appropriate discount rate. Present value of liabilities is calculated by taking the sum of the present values of all future cash flows from the bank's liabilities, discounted using an appropriate discount rate. Let's break this down with a numerical example. Suppose we have Bank X with the following balance sheet items. A fixed-rate loan worth $1 million with an interest rate of 5%, maturing in 1 year. A variable rate deposit worth $800,000 with an interest rate of 2%, maturing in 1 year. Of both the loan and the deposit under the current interest rates, and then see how these values change with a 1% increase in interest rates. First, we calculate the present value of the loans and deposits under the current interest rates. For the loan, the annual interest payment is $1 million and 5%, which equal $50,000. The present value of the interest payment and principal repayment at a 2% discount rate is calculated as per the formula. The present value of the loan will then be $1,029,411. For the deposit, the annual interest payment is $800,000 multiplied by 2%, which equals $16,000. The present value of the interest payment and principal repayment at a 2% discount rate is calculated as per the formula. The present value of the deposits will then be $800,000. Now let's calculate the economic value of equity. Economic value of equity is equal to present value loans minus present value deposit, which gives an economic value of equity of $229,411. Next, let's see how these values change with a 1% increase in interest rates. For the loan, the annual interest payment remains $50,000 as it is a fixed-rate loan. The present value of the interest payment and principal repayment at a 3% discount rate is calculated as per the formula. The present value of the loans will then be $1,019,417. For the deposit, the annual interest payment increases to $800,000 multiplied by 3%, which equal to $24,000. The present value of the interest payment and principal repayment at a 3% discount rate is calculated as per the formula. The present value of the loans will then be $800,000. After the rate shock of 1%, the economic value of equity is equal to $219,417. Now let's calculate the differences between the initial economic value of equity and the new economic value of equity. Before the interest rate shock, the economic value of equity was equal to $229,411. After the interest rate shock of 1%, the economic value of equity decreased to $219,417. We can conclude that the 1% increase in interest rate led to a decrease in the economic value of equity by $9,994. In conclusion, understanding the economic value of equity is essential for managing interest rate risk in the banking book. Economic value of equity provides valuable insights into how interest rate changes impact a bank's financial stability, enabling banks to make informed decisions to mitigate risks and ensure long-term profitability. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more financial insights. See you next time.